So let's talk about the venture market right now. There's the Wall Street Journal had an article, I think last week, saying there was a cash crunch for seed back, and I think in particular they were taking the angle that people like us who had funded sort of seed investors, our companies are having trouble getting follow-on financing. I think this article was just bizarre, like completely out of touch with reality. I literally have not. At Founder Collective, we've not had a single down round, a bridge financing, or anything but up rounds, or exits or positive exits. And we have and I'd love to say I think it's because we're exceptional. I don't think we're that exceptional. I think it's because we represent the market. I mean, in some ways, and the market has been very, very strong for quality companies. What's your impression? of this?
I see the same thing. I think that article was really more of a forecast of a possible outcome in the future.
Sure,
that's how I saw it, right? But not a reality today, right? I mean
I think like Paul Gajrowski tweeted the tense was wrong or something.
Yeah, that's right. Yeah,
It should have been will, and it may very well be the future, but
I'd say may, right? Yeah. I mean, when you look at the numbers, I mean, more than 1,000 startups get funded every year, and if you look at the exits, really only there's about 100 to 200 exits. So by definition, things are going to fall off. So, but to say unilaterally that
I think the numbers. I think more companies get funded, but I think there were 500 exits last year. Mean price of 70.
Exits, right?
70 million or something, and then
And regardless of what the directionally speaking, people are going to go out of business. But I think, and I agree with you 100%. There's plenty of capital available for. Seed rounds are about product market fit and establishing something of value. And in my opinion, those will always get funding as long as you are doing those core things. If your thesis was wrong and you tried and didn't work out, well, of course you're not going to get funding. But most entrepreneurs know that.
I think what also people don't realize. I think when you have a seed portfolio, you realize that there's we have a lot of companies, and you do too, that like I think Weebly is a good example. That are getting real traction, and we're not talking about we're not like the '90s where they were getting paid by other VC firms. I mean, we're like these are like a real product that generates revenue from real non-VC backed customers, right?
Yeah, that's right. Yeah.
And there's a lot of companies like that, at least in our portfolio, and I think in yours.
For sure,
and so this is not driven by kind of like a greater fool theory or the VCs paying up. I mean, these are economically viable entities on their own.
Yeah, they are. The only my question has always been around these super high price later rounds. Are those economically viable at those valuations?
So like people talk about the Dropboxes. I mean, so Dropbox is clearly a real profitable, successful company. You can debate whether, let's say, the highly publicized round was the right price.
Exactly.
But it's still a great company. Yeah.
Absolutely. Yeah. I mean, the list goes on and on about it, and this has been well covered too. There are real companies this time around, as opposed to the '90s, where you and I both lived through, where people were investing on page views, and that's gone now.
Yeah.
Now there still might be a promise of hope of the future of more revenues to come, but just the massive social changes that we're seeing with that technology is providing are building real companies. So I think that the story, like most news stories, are a bit overblown just to create some news and some discussion. So. That's good that created discussion. But I agree with you that I disagree with the fact that it's harder, or that all these companies are going to fail because the upstream funding just doesn't exist. That's just not true.
So like in retrospect, we look back and like when we started doing this stuff seriously, like in 2008, it seemed that was a great time, it turns out, because there were a lot of good companies founded and there weren't that many other seed investors. Now they're sort of the cat's out of the secret's out, so to speak, right? A lot of people are doing seed investing. A lot of these sort of areas in the internet that were sort of out of fashion or in fashion. How do you adapt to that market where you no longer, like how do you Heroku and Weebly or Y Combinator companies, those companies now, they come out, they get, $15 million valuations on day one. It's a very, very different environment now than it was.
Right. It is and it isn't. I mean, my view is that there are barrels where there's a lot of investors looking at deals, and Y Combinator is one of those because it's proven that they create great companies. But that is a small slice of the market, in my opinion. I mean, I think about Kevin at Instagram, or I think about Katrina and Aaron at Stitch Fix, or I think about the guys that just started Iron.io, which is a messaging platform for the cloud. Those were not high price deals where if you didn't get in, you were like you were going to miss out. These are companies that have real entrepreneurs, have a real plan and idea, and they were fairly priced relative to the, in my opinion, to the risk that everyone's taking. And you know, so
you think that's there's still going to be plenty of that?
Alive and well. I mean, I looked at all the things I've done, and I still do Y Combinator companies when the fit with me makes a ton of sense, and will participate. But when I look at the average prices that I've paid since I've started, they've been pretty much the same. And you know, in an up market, you gotta play in the up market. In a down market, you gotta play in the down market. You know, if you believe that technology is going to continue to create value and change, you're always going to be playing. So you know, that's.
And what are the areas you I think you have more of a B2B focus than most investors I know. Like I just know this from what I see. Like what are the areas? I mean, so clearly, like everyone is trying to invest in like, you know, consumer focused, social.
Yeah.
Like you know, so you do different. What are the areas that you particularly like now? I guess.
Well, it's you're right. I've spent a lot of time in the cloud just because I believed when I started that there was a ton of infrastructure changes coming, and then you got things like Instagram and FormSpring and other consumer things. But for the most part, when I look forward, you know, it's hard not to sound trite, but at the same time, you know, when I was at Facebook's F8 this year, it felt to me like what the ecosystem that's evolving around Facebook is undeniably one of the most powerful ecosystems going forward. So a lot of people think that being on Facebook may or may not be a smart thing for a company, as we're seeing in the gaming space, but what they're doing with identity and what they're doing with syndication of ads and using the applications to better signal other apps, to me, we haven't even begun to examine and think about what possibilities are there. So that's interesting. Of course, everyone says mobile. To me, mobile is the extension of the desktop, and they're just cooler things you can do when you have a computer in your hand. But again, that's been well covered. So, you know, social, mobile, infrastructure. I mean, those are broad themes that everyone's looking at. And you know, my strategy is to find pieces in there based on former investments to figure out where the interesting things are.
Okay, cool. Well, I think we're out of time. So thanks for being here.
Thank you, Chris.